Canada's economy is facing a critical juncture. The country's debt-to-GDP ratio, a key measure of economic health, reached a staggering 106.8% at the end of 2024. This means that for every dollar Canada produces, it owes more than $1 to creditors. While this ratio is projected to slightly decrease to 106% by the end of 2025, the sheer magnitude of the debt burden raises concerns about the country's long-term fiscal sustainability. This essay delves into the factors contributing to Canada's debt crisis, exploring key economic indicators and the potential risks they pose to the nation's economic future. The Canadian economy, like many others globally, has been grappling with a multitude of challenges in recent years. The COVID-19 pandemic, geopolitical instability, and global supply chain disruptions have all contributed to a climate of economic uncertainty. These factors have placed significant strain on government budgets, leading to increased borrowing and a subsequent rise in debt levels. While some level of government debt is considered normal and even necessary to stimulate economic growth, excessive debt can have detrimental effects on the economy in the long run. High debt levels can lead to higher interest payments, crowding out other essential government spending on healthcare, education, and infrastructure. The implications of a high debt-to-GDP ratio are far-reaching. It can erode investor confidence, leading to higher borrowing costs for both the government and private sector. This can, in turn, stifle economic growth and limit the government's ability to respond effectively to future economic shocks. Moreover, a high debt burden can place a significant strain on future generations, who may be saddled with the responsibility of repaying debts incurred today. The Canadian government faces a formidable challenge in addressing the country's debt crisis. It requires a delicate balancing act of stimulating economic growth while simultaneously implementing prudent fiscal policies to rein in spending and reduce the debt burden. Failure to address this issue decisively could have profound and long-lasting consequences for the Canadian economy and its citizens. To understand the full scope of Canada's debt crisis, it's essential to examine the interconnected economic indicators that paint a worrisome picture. These indicators provide a snapshot of the country's economic health and highlight the challenges that lie ahead. First, while Canada experienced a real GDP growth of 1.6% in 2024, driven by household consumption and government spending, this growth remains below historical averages. This sluggish growth rate indicates that the economy is not expanding at a pace sufficient to generate the revenue needed to manage the growing debt burden. A robust and sustained period of economic growth is crucial to outpace the debt accumulation and ensure long-term fiscal stability. Second, the unemployment rate, a key indicator of labor market health, rose to 6.7% in March 2025 from 6.6% in February. This uptick in unemployment, with the number of unemployed persons reaching 1,472,700, suggests a softening labor market, potentially signaling a weakening economy. A strong labor market is essential for economic growth, as it leads to higher consumer spending and increased tax revenue for the government. Third, the Bank of Canada's decision to maintain its benchmark interest rate at 2.75% in April 2025 reflects a cautious approach to balancing economic growth and inflation management. While lower interest rates can stimulate borrowing and investment, they can also contribute to inflationary pressures. The Bank of Canada faces the delicate task of setting interest rates at a level that supports economic growth without fueling excessive inflation. Finally, inflation, which measures the rate at which prices for goods and services increase, decreased to 2.3% in March 2025 from 2.6% in February. While this decline offers some relief, inflation remains above the Bank of Canada's target, indicating that the cost of living continues to rise for Canadians. Persistent inflation erodes purchasing power, putting a strain on household budgets and potentially dampening consumer spending. While government debt paints a concerning picture, the rising tide of private debt in Canada adds another layer of complexity to the country's economic woes. Projected to reach a staggering 260% of GDP by the end of 2024, private debt, which includes household debt like mortgages and consumer loans, poses significant risks to financial stability. This mountain of private debt can have several adverse effects on the Canadian economy. Firstly, it can constrain consumer spending, a key driver of economic growth, as households prioritize debt repayment over discretionary purchases. This reduced spending can lead to slower economic growth and potentially tip the country into a recession. Secondly, high levels of private debt increase the vulnerability of households to economic shocks, such as interest rate hikes or job losses. If interest rates rise, as they inevitably will at some point, the cost of servicing debt will increase, putting a strain on household budgets and potentially leading to delinquencies and defaults. Thirdly, excessive private debt can create systemic risks for the financial system. If a significant number of borrowers default on their loans, it can trigger a domino effect, leading to financial instability and potentially a credit crunch. This can further exacerbate economic woes and make it more challenging for the government to manage its own debt burden. As we navigate the complexities of the global economic landscape, it's crucial to understand the interconnectedness of national economies. The ripple effects of financial policies, trade agreements, and economic shifts can be felt far beyond a country's borders. This interconnectedness means that no nation is an island, economically speaking. Every decision made on the global stage can have profound implications for Canada's economic health. Looking at examples from around the world, we can glean valuable insights into managing national debt. Countries like Norway, with its sovereign wealth fund, have demonstrated the benefits of prudent fiscal management and long-term planning. On the other hand, Greece's debt crisis serves as a cautionary tale of what can happen when debt spirals out of control. Learning from these diverse experiences can help Canada chart a more stable and prosperous economic future. Addressing Canada's debt crisis requires a multifaceted approach. Policy options include implementing more stringent fiscal policies, increasing revenue through tax reforms, and reducing unnecessary expenditures. Additionally, investing in growth sectors such as technology and green energy can stimulate the economy and create jobs. It's about finding a balance between austerity and growth, ensuring that the burden of debt does not stifle economic progress. Ultimately, overcoming Canada's debt crisis is a shared responsibility. It involves the collective effort of the government, businesses, and citizens alike. Transparency and open dialogue are essential, as is a commitment to making tough but necessary decisions. By working together, we can ensure a sustainable economic future for Canada, one where prosperity is shared and the burden of debt is managed responsibly. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.